The ECB cut later today, all but certain, but what does that mean for European equities?
So look, this move has been very widely anticipated, so we shouldn't have any surprises here, right? But let's not forget, if anything is going to be a tailwind, but let's not forget that equities are not only a rates-driven market, it's about the fundamentals as well. And we are seeing signs that fundamentals are inflecting, are improving. Economy in the Eurozone is improving, and this all weighs on the performance going forward. So we have another 4% upside for European equities by the end of this year, and they should be really achievable given what the fundamentals are doing. So it's not only what the analysts are expecting, around 7% upside for EPS this year after a negative year last year. Actually, we are seeing signs that this number could be higher, and as they are upgrading, given what is happening in the economy.
You know, the first time we had you on the show was to talk about what you call the European Super 7. Here in the U.S., it's the mega cap tech names, our Mag 7, that's really been the drivers of the market. What does this cut mean for those big stocks over there in Europe that you believe are going to take leadership, or you believed earlier this year are going to take leadership? Does that change at all?
Look, these stocks have been always expected and continue to deliver superior growth, superior margins to the versus the overall European market, right? So that has not changed. And what we've seen over the past few days from the big tech out of the US, probably you might see improvements overall that will impact the profitability of Europe as well. However, Europe is a bit different to the US, right? The US market tends to narrow into the mega cap stocks more often than Europe. For Europe, like a more natural way of outperformance is broadening, which actually over the past month and a half we've been seeing, right? So we've been moving away from this European Super 7 into the broader range of sectors and companies contributing to market returns. So if indeed economic activity continues to pick up, we see broadening of EPS, and that's happening over longer term. I think broadening is a more natural way for Europe.
Got it.
Narrowing, given what is happening now in the US, is definitely a risk and reversal of what we've just seen over the past month or two.
Okay, so you are looking at the U.S., so I want to ask you, it's the big question this morning that we're going to be talking about all day here on CNBC. Do you think the ECB, if it does cut as expected, does that influence the U.S. Fed, and how does that influence the global markets?
So our economists think that the central banks right now work pretty independently, even more than in the past. So it's about what is happening in your local economy and inflation. For the ECB, for the time being, it's a pretty straightforward picture, right? To cut today, and we have another two cuts happening in September and in December, and more to come next year. What is important, though, that even after the cuts, the terminal rate for the ECB is going to be much higher than in the post-GFC world. We argue it's good. It's an upgrade for cyclicality, for cyclical equities, not only Europe, but Europe being, of course, one of the beneficiaries. Now, for the Fed, of course, the economic momentum is slowing down. So Citi, US economists are worrying about the rollover in employment data, right? So we'll be watching what is happening, the update on payrolls tomorrow very closely. And they actually think that there is still a chance for the Fed to start cutting in July if this weakness in the labor market continues.